Welcome, everyone, to another deep dive. I hope you're having a fantastic week and are ready to plunge into a subject that, well, truly touches almost everyone's daily life: telecommunications. Today, we're taking a comprehensive look at Verizon Communications, Inc., exploring its fundamental strengths and, crucially, its critical challenges in what's definitely a rapidly evolving landscape.
That's right. Our mission today is to answer a really fundamental question for anyone looking to truly understand this behemoth for the long term. Is Verizon a truly wonderful company, the kind you could comfortably hold for decades, or does it present itself as more of a value trap in an increasingly challenging industry? We're going to apply a rigorous framework to dissect the durability of its business, the strength of its competitive advantages, and importantly, the stewardship of its management.
Yeah, we've spent considerable time dissecting and synthesizing quite an extensive analysis on Verizon. Our goal is to guide you through the most important takeaways, helping you connect the dots and understand what truly matters for this company's potential future. So let's start at the very beginning. At its core, how does Verizon actually generate revenue, and how straightforward is that business model for us to wrap our heads around?
It's interesting. For a company of Verizon's sheer scale, its underlying business model is remarkably simple and highly intelligible, actually. Essentially, they are in the business of building, maintaining, and operating these massive wireless and wireline telecommunications networks. Once those networks are in place, acting as essential digital highways, if you will, they then charge customers recurring fees for access and services. It's a very direct model, and historically a very stable revenue model, too. Now, this core business breaks down into two primary operating segments. Understanding the nuances here is, I think, pretty crucial. The first, and by far the largest, is the Verizon Consumer Group. This segment accounted for approximately 76% of the consolidated revenues back in 2023. This is what most people immediately recognize as Verizon, right? Providing wireless services, they serve a colossal 115.2 million retail connections, offering both postpaid plans, billed monthly after usage, and prepaid plans. The lion's share revenue here comes from those sticky monthly access fees for voice and data services. That's the core. But it also includes device sales, which are often financed over time, and increasingly from home broadband services. This home connectivity piece is delivered via their high-speed Theos fiber optic network, mostly in the Northeast, serving about 7.2 million internet customers. And critically, it also comes from their rapidly expanding 5G fixed wireless access, or FWA, product, which leverages their existing wireless network to provide home internet. The second key segment is the Verizon Business Group. This contributes about 22% of 2023 revenues. This group serves an incredibly diverse and often mission-critical client base. We're talking everything from small and medium-sized businesses all the way up to, I think it's 99% of the Fortune 500 companies and various government agencies, too. While it still provides core connectivity services, its strategic focus is increasingly on, higher margin, more sophisticated solutions. Things like Internet of Things, or IoT, connectivity. That's the backbone for things like smart cities, connected vehicles, industrial automation. They also provide managed cybersecurity services, cloud computing solutions, and even private 5G networks, custom built for large enterprise campuses.
Okay, so the recurring service revenues are really the backbone that creates that stable cash flow base we hear about. With device sales and these large business contracts acting as supplements, I know there's still a tiny sliver coming from some legacy media properties they acquired, like Yahoo, but that's a truly minor piece now, right?
That's negligible now. The dominance of recurring service revenues is absolutely central to their stability and predictability. What's truly remarkable, and maybe often overlooked, is the fundamental simplicity and the enduring nature of this core model. Just selling connectivity. It's anchored in fundamental human behaviors that are not just here to stay, but expanding rapidly. Think about it. High-speed connectivity has really transitioned from being a luxury to an essential utility. It's now as indispensable as electricity or water for daily life, education, commerce, everything. We rely on it completely. And the demand for data, that's on a perpetual upward trajectory. It's relentless. This isn't just a trend, it's a fundamental shift, driven by the explosion of high-resolution video streaming, the pervasive move to cloud computing, and this ever-expanding universe of connected devices under the Internet of Things umbrella. The GSMA, for example, projects that IoT connections in North America alone will more than double by 2030, growing at, an impressive 12% annual rate. So while the underlying technology will continuously evolve, we've seen the leap from 4G to 5G, and 6G is already on the horizon. The fundamental need for this network toll road, as you might call it, persists and actually intensifies.
Right. But, and this is kind of the elephant in the room for many, the US smartphone market is incredibly mature, isn't it? I mean, pretty much everyone who wants a smartphone likely has one already. So if they can't simply add new phone lines like they used to, how has Verizon's strategy truly evolved beyond just selling that basic phone line? Where's the new growth actually coming from?
You've hit on a really critical point there. It forces a deeper strategic pivot. The U.S. smartphone market has indeed reached a very high level of penetration, saturation, basically. This means that significant growth from simply adding new phone lines is increasingly limited. It's just not the engine it once was. Consequently, to truly drive future growth and defend its competitive position, Verizon has had to strategically shift its focus. It's no longer just about getting a new customer. It's about extracting more value from its existing customer base and expanding into adjacent markets where its network can be leveraged. This has led to a much more sophisticated but necessary go-to-market strategy, moving beyond just selling a single product to selling an entire bundled ecosystem of connectivity. A great example of this is their MyPlan structure. This isn't just a new pricing tier, it's a modular approach. It allows them to unbundle popular perks like various streaming services and sell them as, say, $10 monthly add-ons. It's a way to enhance the core offering, increase the average revenue per user, or ARPU, and give customers more perceived value. But perhaps the most aggressive and important push has been into fixed wireless access, FWA. By bundling a customer's mobile service with their home internet, Verizon creates a significantly stickier relationship. It's harder to leave. This dramatically increases switching costs for the customer, making them far less likely to jump ship, and it naturally lowers churn. So for Verizon, long-term success isn't just about having a high-quality network. It's crucially about their ability to execute this sophisticated bundling and upselling strategy effectively, to generate new revenue streams and lock in those customers.
That's a fascinating pivot. Definitely sounds more complex than just selling phone lines. But how strong is Verizon's competitive fortress in this mature and increasingly bundled world? Where does its true durable advantage come from?
Verizon's competitive advantage, its economic moat as we call it, isn't really a single silver bullet. It's more of a powerful composite, a combination of cost advantages derived from its immense scale and intangible assets, primarily in the form of its brand reputation for network quality. Analysts often point directly to these. Let's break that down a bit. The telecommunications industry is what we often call a natural oligopoly. This means it naturally tends to be dominated by just a few huge players, not necessarily through anything nefarious, but simply because the barriers to entry are astronomically high. Imagine needing to build, say, a national railway system from scratch today. The sheer cost of land, tracks, trains, it's prohibitive. Telecom is similar. Building a nationwide network requires tens of billions of dollars just for spectrum licenses, those essential radio frequencies, and then tens of billions more for all the physical infrastructure, cell towers, fiber optic cables crisscrossing the country, ongoing network maintenance. It's immense. With over 146 million connections, Verizon boasts the largest wireless subscriber base in the United States. This enormous scale allows them to spread those huge fixed costs across a far larger number of users than any potential competitor. This directly translates into superior profitability and, historically, better returns on capital compared to smaller players. The sheer amount of capital required to replicate this network from scratch is a truly formidable barrier to entry. It makes it virtually impossible for a new player to directly challenge them nationally. Complementing this huge scale advantage is the intangible asset of the Verizon brand itself. For decades, Verizon has meticulously cultivated a reputation for having the most reliable network with the broadest coverage. This perception is particularly strong in rural America, where coverage can literally be a lifeline. This brand equity acts as a powerful psychological backstop for customers who prioritize dependability above all else. It's a powerful asset. It enables Verizon to command premium pricing, and historically it has allowed them to maintain the lowest customer churn rates among their main peers. They are often seen as the gold standard for network quality.
Okay, this concept of an economic moat is powerful, but sometimes it can feel a bit abstract, you know? Could you bring it to life for us? What's a recent real-world example where Verizon's competitive advantage truly played out, maybe even defining expectations?
Yeah, absolutely. A very clear and quite recent example occurred in early 2025 in what was widely described by industry watchers as an unusual quarter from a competitive intensity standpoint, meaning competition was unusually fierce. Verizon deliberately went forward with price increases on its plans. Now, in a highly competitive market, raising prices typically sounds like, well, recipe for disaster, doesn't it?
Right, you'd expect customers to flee.
Exactly. But Verizon management was incredibly explicit about their rationale.
They stated that this move was expected to generate over $1 billion in incremental revenue. And critically, they acknowledged quite openly that it would cause elevated churn in the short term. They knew some people would leave, but their conclusion, and this is the key phrase that really demonstrates their confidence in their moat, was, I'll do that trade-off any day. Mm-hmm. This isn't just a simple pricing decision. It's a textbook demonstration of pricing power. Power conferred by a strong economic moat. The ability to knowingly raise prices, accept some customer losses, but still be confident that the majority of their high-value customer base will stay because they value the perceived superiority and essential nature of the service. It's a hallmark of a powerful competitive advantage. They're betting on that network stickiness.
So the moat is powerful. They clearly have some pricing power. But what about its trajectory? That's the crucial question for long-term investors. Is this fortress stable, or is it showing cracks? Is it eroding over time, which would push it closer to that value trap scenario we talked about?
That trajectory question is absolutely critical. It really gets to the heart of the wonderful company versus value trap debate. We can probably assess Verizon's overall moat as stable, fundamentally. But, and this is a very important nuance, it introduces considerable tension. A key component of its intangible asset, specifically the technological gap in network performance, is demonstrably narrowing. The evidence for the moat's fundamental stability is quite strong, I think. Their scale advantage isn't diminishing. They remain the largest U.S. carrier by subscribers, which continues to provide those massive cost benefits. Their brand, despite some challenges we'll definitely discuss, continues to be associated with reliability in the minds of many consumers and, critically, with their indispensable enterprise clients. And the fundamental industry structure. It remains an oligopoly with those essentially insurmountable barriers to entry we discussed earlier. It's not like new national players are suddenly popping up. However, the evidence of that narrowing technological gap is equally compelling and frankly cannot be overlooked. Competitors, most notably T-Mobile, have invested aggressively and, you could argue, very effectively in their own networks, especially after acquiring Sprint's valuable mid-band spectrum. T-Mobile has really closed the performance gap. Mid-band spectrum is often called the Goldilocks spectrum for 5G. It delivers both wide coverage and high speeds. It's the sweet spot. And by many independent metrics, T-Mobile now actually leads in 5G coverage and speed, particularly in urban and suburban areas. Morningstar captured this threat quite well, noting something like, wireless technology is dramatically lowering the cost to build and maintain a network. Verizon's network leadership is a thing of the past. That's a pretty strong statement, right? It indicates that the pure technological edge Verizon once clearly held is significantly diminished, if not gone in some areas.
Yeah, that really crystallizes the tension. It raises this important question that goes right to the heart of our discussion today. Can the enduring power of its immense scale, its legacy brand, and that stickiness from bundling, can those things truly offset this ongoing commoditization of pure network speed? It's a dynamic tension, absolutely, where the past advantages meet these very real future challenges. #Titanic mental models. Okay, let's try and connect this to some established mental models that might help us deepen our understanding. How does Verizon fit into the investment philosophies of, say, people like Warren Buffett and Charlie Munger? Their frameworks often distill complex businesses down to their core essence.
Oh, absolutely. Verizon's business is a truly rich case study for several powerful mental models. It helps understand the durability and fundamental nature of its competitive advantages. It's almost like they built a business designed to illustrate these concepts. First, let's look at the toll bridge, a concept famously used by Warren Buffett. Buffett describes a great business as an essential, difficult-to-replicate piece of infrastructure that generates steady, recurring revenue from all the traffic that must use it. Verizon's network is precisely that, a modern digital toll bridge. The traffic is data, and its volume is growing exponentially every single year. To participate in our modern digital economy working remotely, learning online, shopping, entertainment, just communication, you basically have to cross this bridge. As one of only 3 major bridge owners in the U.S., Verizon charges a recurring toll, that monthly service fee. The immense, often debt-funded capital expenditures required to build and maintain this bridge like that, over $50 billion for C-band spectrum licenses, plus another $10 billion for deployment, are exactly what deters new competitors. Imagine the sheer financial and logistical nightmare of trying to recreate this infrastructure from scratch across an entire continent. It's just not feasible. This makes it an incredibly powerful, enduring asset that is nearly impossible to replicate. Next, we have scale economies, a principle that Charlie Munger frequently emphasizes as a powerful competitive advantage. Munger highlights the powerful benefits that accrue simply from enormous size. Verizon is a textbook example here.
Its enormous scale provides advantages at nearly every operational level. Consider its purchasing power. It can negotiate far better terms from key suppliers like Apple and Samsung because of the sheer volume of devices and equipment it buys. Furthermore, its massive fixed costs, things like nationwide advertising, corporate overhead, R&D, network management, are spread over a colossal customer base and revenue pool. This results in a significantly lower cost per customer compared to smaller players. This structural advantage is a primary reason why Verizon has historically been able to achieve and maintain superior profitability compared to rivals. It can just do things cheaper at scale.
And finally, perhaps most profoundly, Verizon's moat isn't simply the sum of these parts. It's a prime illustration of what Munger calls a Lollapalooza effect. This is where multiple factors combine and reinforce each other in a nonlinear way, creating an overwhelmingly powerful outcome. Think about building a fortress, right? One strong wall is good, but if you then add a deep moat, maybe filled with crocodiles.
Right, then electrify the wall.
Exactly, and guard it with elite soldiers. Each defense doesn't just add to the strength, it multiplies it. Makes the fortress exponentially harder to breach. That's Verizon's moat. Immense capital barriers to entry, huge scale-based cost advantages, a powerful decades-old brand synonymous with reliability, and high customer switching costs, especially for multi-line families and large businesses who are very reluctant to risk service disruption. These forces don't just add up, they multiply and amplify each other, creating an exceedingly difficult competitive position to breach on all fronts simultaneously. It's a truly formidable combination, more than the sum of its parts. Scuttlebutt simulation, customer and employee perspective.
That's a powerful framework to understand the business on paper, definitely. But here's where it gets really interesting for me. What does a scuttlebutt approach, looking at Verizon from the ground level, from its customers and employees, what does that reveal? Because sometimes what's on the balance sheet doesn't quite match the real world experience, does it?
You're absolutely right. And this scuttlebutt approach reveals a stark and rather telling dichotomy in customer experience. It's almost like looking at two completely different companies depending on who you talk to. For the individual single-line consumer, the sentiment is, frankly, overwhelmingly negative, often bordering on hostile even. If you look at customer review aggregators, think Better Business Bureau. Consumer Affairs, you'll typically see composite ratings, often near a dismal 1 out of 5 stars. It's quite bad. The complaints are consistent and damning. Horrible customer service, chronic billing errors, aggressive or even deceptive sales tactics. Perhaps most frustratingly, an inability to reach a competent human agent who can actually resolve complex issues. You just get stuck in phone trees or talking to bots. A recurring theme from loyal long-term customers is this profound feeling of abandonment, being shuffled off to offshore call centers, met with scripted, indifferent responses that just fail to address their specific problems. It paints a picture of extreme frustration. Now, in stark contrast, the picture for enterprise customers is significantly brighter, completely different story.
On platforms like Gartner, where reviews are predominantly from business and IT users, the feedback is largely positive, dominated by 4- and 5-star ratings. These customers consistently praise Verizon's network for its superior reliability and coverage, especially in rural or remote areas that are absolutely critical for their operations. Imagine a trucking company needing constant connectivity across the whole country.
Yeah, mission-critical stuff.
Exactly. They frequently highlight responsive and knowledgeable dedicated account representatives and seamless transitions to new plans. These business clients often explicitly state that while Verizon might not be the cheapest option, the premium is fully justified by the robust, dependable, and mission-critical nature of the network. They see it as an essential utility for their business, where uptime directly impacts their bottom line.
Okay, that bifurcation is striking. And it doesn't sound accidental, does it? You're suggesting this underinvestment in consumer support might be a deliberate strategy to boost margins, even if it frustrates individual customers. But isn't that a really short-sighted approach for a company built on a trusted brand? Could this calculated wager backfire spectacularly if a competitor truly offers both network quality and superior service down the line?
It absolutely appears to be a deliberate feature of their business strategy, yes, not some accidental oversight. They seem to be leveraging the inherent stickiness of their network moat, the fact that people don't easily switch carriers because of the hassle and the risk of service interruption, to consciously underinvest in customer support for their most price-sensitive individual consumer accounts. These significant cost savings derive from outsourcing and automating the support function. They directly bolster operating margins, make the quarterly numbers look better. It's a calculated wager. They're betting that the resulting customer frustration won't lead to a level of churn that would actually offset these cost savings. And historically, the fact that Verizon has maintained competitive churn rates for years suggests that this, well, cold financial calculus has, at least in the short term, been financially successful for them. They've optimized for profitability in the segment, maybe at the cost of brand affinity. But you're entirely right to call it a perilous long-term strategy. It's playing with fire, potentially. While it undeniably enhances near-term profitability, it systematically erodes the brand and reputation components of its intangible asset moat. That's the risk. It risks transforming Verizon from a loved or highly preferred premium service into a merely tolerated utility, a necessary evil, maybe, that customers stick with out of inertia rather than genuine loyalty. This makes the company far more vulnerable if or when a competitor manages to match Verizon's network quality and provide a truly superior customer experience. At that point, that hard-won brand loyalty, or what little remains for consumers, could turn into a liability. Customers might jump ship much more readily than management currently anticipates. There's probably a breaking point somewhere. As for the employee perspective, if you look at platforms like Glassdoor, Reddit, places where employees talk, the sentiment paints a picture of a high-pressure, sales-driven culture, particularly within retail and other consumer-facing divisions. While employees often acknowledge that compensation and benefits can be quite good, there are persistent complaints about burnout from aggressive sales quotas, intense micromanagement, and a general feeling of being unappreciated. Critically, a recurring theme among employees is the outsourcing of many corporate functions, especially support roles, to overseas locations. This internal employee feedback directly corroborates the external customer complaints we just discussed. It provides a very clear causal link to that poor consumer service experience. It really ties the two observations together, indicating a systemic choice has been made. #tag competitive landscape.
Okay, so that tale of two customers really paints a vivid picture of Verizon's internal dynamics and strategic choices. But how do its primary competitors, T-Mobile and AT&T, exploit or navigate these strengths and weaknesses? What does this mean for the ongoing battle in this very mature market?
Yeah, the U.S. wireless market is definitely a mature oligopoly, as we've established. And it's dominated by these three national players constantly vying for market share and, crucially, for customer loyalty. It's a tough fight. First, you have T-Mobile, TMUS. They've successfully branded themselves as the Un-carrier, right? Fundamentally disrupting traditional industry norms. Their core strategy revolves around being the leader in both value and, importantly, 5G technology. They compete with slightly cheaper plans than Verizon, typically. And they often bundle numerous popular perks like Netflix subscriptions designed to add perceived value beyond just connectivity. Get you hooked on the extras. Crucially, they aggressively market their superior 5G network speeds and coverage, often touting independent speed test results. They want you to believe their network is best now. Their historical weakness was maybe a smaller 4G LTE network, which could mean less reliable coverage in rural areas compared to peers, but they've been rapidly closing that gap, particularly after the Sprint acquisition gave them that significant boost in valuable mid-band spectrum. They are actively eroding Verizon's traditional lead in network perception, no doubt about it. Then there's AT&T. AT&T has positioned itself more as the balance bundler. Their strategy is to occupy a solid middle ground, offering a competitive balance of price, nationwide coverage, and network reliability. Sort of the steady hand. A key pillar of their strategy is to aggressively bundle their wireless services with their large and growing AT&T Fiber Home Internet service.
Right, the bundle is key for them.
Absolutely. For many customers, bundling mobile and home internet can lead to significant savings and convenience. It's a powerful hook. AT&T's key strengths are its vast 4G coverage, which actually rivals Verizon's in many areas, and its significant fiber footprint, which gives it a strong base for that bundling strategy. Their primary weaknesses are probably that their 5G network speeds generally lag behind T-Mobile's, and their overall network reliability perception, while good, is still often considered a step behind Verizon's by discerning customers, especially businesses.
Okay, so given T-Mobile's aggressive 5G push and AT&T's bundling prowess, what's Verizon's key durable advantage in this environment? Are they just relying on that existing brand reputation, or are there maybe new technologies or pricing strategies they're deploying to try and claw back that performance perception, especially for consumers?
It's a great question. Against this very competitive backdrop, Verizon's most durable advantage really remains its entrenched position with high-value enterprise and government customers, combined with its long-standing, powerful brand reputation for ultimate network reliability. That's still the bedrock. While T-Mobile might be winning the 5G speed race in many urban centers and AT&T is pushing bundles hard, Verizon remains the provider of choice for businesses, for first responders, for government agencies, entities where network uptime and ubiquitous coverage are simply non-negotiable.
Can't afford downtime.
Exactly. If their system goes down, it has far more severe consequences for a business's operations than a single consumer's Netflix stream buffering. For these clients, the premium Verizon charges is seen as an investment in resilience. They pay for peace of mind. This deep entrenchment in the mission-critical segment of the market allows Verizon to maintain a level of pricing discipline and focus on profitability, rather than just chasing subscriber growth at any cost. This focus on profitable relationships, as opposed to sheer volume, is a strategic differentiator from competitors, particularly T-Mobile during its aggressive Un-carrier phase, which is all about growth. Verizon's response to the narrowing 5G gap is largely to lean into its legacy of reliability and continue to invest heavily, particularly in that C-band spectrum, to ensure capacity and quality, even if not outright speed leadership everywhere. They believe that ultimately the most reliable network wins, especially with those high-value customers. It's also worth noting their consumer churn is still very competitive. Postpaid phone churn in Q4 2024 was 0.89%.
That's very comparable to T-Mobile's 0.90% in Q2 2025 and AT&T's 0.87% in Q2 2025. So customers aren't exactly fleeing in droves. Price-wise, their top-tier unlimited ultimate plan for one line is $90. T-Mobile's Experience Beyond is $100. AT&T's unlimited premium is $86. So they are competitive, but often still command that slight premium, leveraging that brand perception, particularly for multi-line family plans where perceived reliability is still critical. They are responding for sure, but it's a strategic long-game response, not a race to the bottom on price.
Okay, we've built a picture of Verizon's business, its defenses, the competitive landscape. But for any long-term investor, the true durability of a company often rests on the shoulders of its leadership and, the bedrock of its finances. So let's turn our attention now to the people steering this massive ship and the strength of its financial fortress. What's the CEO's philosophy, and how has his tenure been characterized so far?
Right, Hans Vestberg. He's been CEO since August 2018. And he has articulated a remarkably consistent operating philosophy throughout his tenure. It's almost like a mantra for him. This philosophy is deeply anchored on one central theme: network leadership as the non-negotiable foundation for all future growth. He truly believed that having the best, most reliable network is the key to everything else, the ultimate competitive advantage. His signature phrase, you'll hear him say it often, is 5G built right. This isn't just marketing fluff. It really emphasizes Verizon's primary strategic advantage stemming from its superior spectrum portfolio and its commitment to building the most reliable and powerful 5G network in the nation. That colossal multi-billion-dollar investment in C-band spectrum, over $50 billion just for licenses, another $10 billion for deployment, was framed not as a catch-up move, but as a decisive forward-looking action. To extend this network leadership for the next decade, he was essentially buying prime digital real estate for the future. The explicit strategy flowing from this network focus is growth via network monetization. Makes sense, right? The idea is to leverage this superior network asset to drive growth in three key areas: the core mobility business, that rapidly expanding fixed wireless access, FWA, home internet business, and new high-growth enterprise services like private networks and mobile edge computing. He sees the network not just as an expense, but as the engine for all these potential revenue streams, allowing Verizon to capture more of the customer's wallet over time. And finally, he consistently highlights financial discipline, focusing intently on growing wireless service revenue, expanding adjusted EBITDA, which is a key profitability metric in this capital-intensive industry, basically earnings before interest, taxes, depreciation, and amortization, and generating strong free cash flow. Alongside these growth and profitability goals, debt reduction is frequently cited as a top priority for capital allocation, particularly after that huge C-band investment. Now, from an owner's perspective, Vestberg's long-term focus on fortifying the core network asset is genuinely commendable, you could argue. It demonstrates a clear understanding of where the company's durable value truly comes from. However, his tenure has also been characterized by massive, debt-fueled capital outlays, prioritized over more direct returns to shareholders like share buybacks. His philosophy could be interpreted as, fortify the fortress at all costs, and shareholder rewards will eventually follow, which contrasts with maybe a management philosophy that might prioritize buybacks or a higher dividend payout more directly today. Despite this capital intensity, though, Verizon has maintained a remarkable record: 18 consecutive annual dividend increases under his leadership. That shows an unwavering commitment to at least that critical form of shareholder return.
It's clearly a sacred cow, as they say.
That's a clear philosophy. But are management's incentives truly aligned with shareholders? Do they have enough skin in the game in a way that truly matters for long-term owners?
The alignment actually looks quite strong based on their disclosures. It's something they clearly articulate in their proxy statements. If you look at their 2025 proxy statement, it's clear that approximately 90% of the named executive officers' total pay is variable and incentive-based. That's a big chunk. This structure is really designed to tie their personal financial success directly to the company's performance over the long haul. The long-term incentives are delivered as performance stock units, or PSUs. These aren't just regular stock options. Their payout is contingent on achieving rigorous goals for things like cumulative adjusted earnings per share, EPS, which measures profitability. Also, cumulative free cash flow, which tells us how much cash the business actually generates after all its expenses and capital investments, and cumulative service and other revenue, which measures top-line growth. So it's not just about top line, but also profitability and, crucially, cash generation. Furthermore, the final payout can be adjusted by up to 25% based on Verizon's total shareholder return, TSR, relative to the S&P 100 index. This adds another layer of accountability, incentivizing them to outperform their peer group in the market. And to ensure skin in the game, the company has very robust stock ownership requirements. For example, the CEO must own stock equivalent to at least 7 times his base salary. Others, 4 times. That's significant.
That's quite a bit, yeah.
It is. As of early 2025, all named executives were in compliance with these guidelines. CEO Hans Vestberg personally held over 1.2 million total stock-based units. This significant personal investment ensures that their financial fortunes are directly tied to the common shareholders. They literally feel the pain and gain alongside you.
Okay, so they're incentivized correctly. They have skin in the game. But what about their actual capital allocation track record over the past decade or so? Where has this massive company actually put its money? And crucially, does it make sense from an owner's perspective?
Yeah, analyzing Verizon's capital allocation over the past decade really reveals clear, dominant priorities. And we can apply a kind of rationality test to these decisions. Reinvestment, or capital expenditures, CapEx, has been the overwhelming dominant use of capital, no question. As a highly capital-intensive business, they've consistently spent heavily just to maintain and upgrade their vast networks, which are routinely tens of billions annually. 2025 guidance is $17.5 billion to $18.5 billion. And this spending was dramatically supercharged by that 2021 C-band spectrum auction. Verizon committed over $50 billion for licenses, another $10 billion for deployment. That was truly a defining capital allocation decision of Vestberg's tenure. Now, from an owner's perspective, pouring capital into their primary moat, the network, is a logical and defensible choice for a business like this, especially to maintain competitive parity. You have to keep investing. When it comes to mergers and acquisitions, M&A, the company's track record is, well, decidedly mixed, let's be honest.
Their ill-fated foray into media, with the value-destructive acquisitions of AOL in 2015 and Yahoo in 2017, that stands as a stark cautionary tale, straying far from their core competence. Clear misallocations of capital.
Yeah, those didn't work out well.
Not at all. However, more recent transactions appear much more strategically sound, more rational. This includes the 2021 acquisition of TracFone for about $7.1 billion, which significantly bolstered their prepaid wireless business by adding millions of customers, and the pending 2025 reacquisition of wireline assets from Frontier Communications. That's clearly designed to support their core bundling strategy by expanding their fiber footprint into new areas. These moves seem more aligned with strengthening the core. Finally, for shareholder returns, the dividend is clearly a sacred cow at Verizon, central to their value proposition. They have that remarkable record, 18 consecutive annual dividend increases, something management is visibly proud of. In the first half of 2025 alone, they paid out $5.7 billion in dividends. The payout ratio, around 63% of earnings, maybe 58% of free cash flow, is reasonable. Clearly sustainable given their predictable cash flows. However, share buybacks have been largely absent in recent years. Pretty much zero.
Following the massive debt assumption to buy out Vodafone's stake in Verizon Wireless back in 2014, and then again after the C-band auction in 2021, capital has been consistently prioritized for network investment and deleveraging, not buybacks. For context, looking at 2020-2024, annual capex ranged from $17.3 billion up to $23.1 billion. Dividends paid were $10.2 billion to $11.3 billion, but share repurchases, $0.0 billion during this entire period. This lack of buybacks, especially when the stock has appeared cheap by historical standards, means less flexibility for management. The decision to fund these priorities with enormous amounts of debt has really constrained their financial flexibility. #tag financial fortress, a qualitative view.
Okay, so we've seen their capital allocation priorities: network first, dividend second, debt reduction maybe third, buybacks. not really on the list recently. But what does this all mean for the overall financial sturdiness of the company? Is Verizon's financial fortress truly strong enough to withstand economic storms, or is it perhaps more vulnerable than it appears at first glance because of that debt?
That's the key question, isn't it? Verizon's financial fortress is certainly built on a foundation of strong, predictable cash flows. That's its strength. But it does carry the considerable weight of a heavy debt load. It's important to understand this nuance. It's not a fortress built pristine and debt-free. It's a fortress built with debt. The question is that debt an Achilles heel or just a manageable part of its structure? In terms of profitability and consistency, it's generally robust and consistent. And this is a direct result of their immense scale advantages and that recurring revenue nature of the oligopolistic market. The core wireless business is undoubtedly their profit engine, generates nearly all the company's operating income. Their operating margins have been reliably stable, typically residing in the low to mid 20% range. Pretty consistent. While reported net income can sometimes appear volatile due to one-time special items, for instance, they had that $5.8 billion goodwill impairment charge related to their business segment in 2023. The underlying operational profitability of the enterprise remains remarkably steady and predictable. This consistency provides a cushion. Looking at some key quality ratios gives us a deeper look into the financial health. Return on invested capital, ROIC, is an area where Verizon has been somewhat mediocre. And this is a critical point for that wonderful company debate. Think of ROIC as how effectively a company uses every dollar it puts into the business to generate profits. For Verizon, while it's profitable, the sheer size of the capital base required to compete effectively depresses its returns on investment. Morningstar estimated ROIC was a healthy 16% prior to 2021, but it fell into the low double digits after that massive C-band investment. More recently, in 2024, it was in the 7-8% range, specifically 7.4%.
So not exactly setting the world on fire there.
No. While this is likely still above their cost of capital, it's certainly not the hallmark of a truly wonderful compounding business that generates exceptional returns on new capital. It signals that while they're profitable, the sheer cost of building and maintaining that network prevents them from generating exceptional returns on new investments. However, free cash flow, FCF conversion, is a significant strength. This business model is a true cash generation machine. For the full year 2024, Verizon generated $19.8 billion in free cash flow against a net income of $11.6 billion. That's a conversion rate well over 150%, specifically 171%. That's impressive. This powerful cash generation is the primary reason the company can simultaneously service its substantial debt, fund its massive capital expenditures to maintain its edge, and sustain its steadily growing dividend. Management has rightly made FCF generation a top priority, and they consistently deliver. Now, for balance sheet strength, specifically net debt to EBITDA, this is arguably the most significant vulnerability in Verizon's financial fortress. The balance sheet is indeed heavily leveraged.
Following the C-band auction, net debt ballooned to over $150 billion. That's a huge number. Management has since made progress on deleveraging. The net debt to adjusted EBITDA ratio now stands at approximately 2.3x, down from a peak of around 2.9x.
Okay, so moving in the right direction, but still high.
It's still high, yes. Typical healthy companies might aim for below 2.0x or even 1.5x, but it's generally considered manageable for a business with such predictable cash flows. However, the sheer absolute debt level remains a significant constraint on financial flexibility. It limits their ability to seize new opportunities, makes them more vulnerable to interest rate hikes, and prevents those substantial share buybacks we talked about. So in essence, Verizon's financial strength comes not from a pristine debt-free balance sheet, but from the exceptional quality and predictability of its cash flows, which are protected by its economic moat. These cash flows allow it to simultaneously service that large debt pile, fund massive capital projects, and pay that steadily growing dividend. The entire investment thesis, from a financial perspective, really rests on the belief that these cash flows will remain durable enough to allow the company to slowly but surely reduce its leverage over time. The greatest financial risk, therefore, is an unexpected and significant erosion of that moat and its associated cash flows before the debt is paid down to more conservative levels. If the cash flow engine sputters significantly, that debt becomes a much, much heavier burden.
Okay, that gives us a clear picture of the financial foundation's strong cash flows, but weighed down by debt. Now, let's unpack this from the market's perspective. What's the current take on Verizon's valuation? Is the market seeing a wonderful company or more of a value trap?
Yeah, the market's view is pretty clear. Verizon, historically, and still currently, trades very much as a mature, low-growth, high-yield value stock. That's its category. Its valuation multiples are consistently in the bottom tier of the broader market. For example, it currently trades at a forward price-to-earnings PE ratio of approximately 9x. If you look at its historical 5 and 10-year average PE ratios, they're typically in the 11-12x range. So that 9x represents a significant discount, not only to its own historical average, but also to the broader market and certainly to higher growth peers like T-Mobile, which often trades at a PE multiple well above 20x. The market's reasoning for this persistently low valuation is quite clear and, from its perspective, rational. It sees the company facing several significant headwinds. First, slow top-line growth in what is a very saturated U.S. wireless market. Second, intense and unrelenting price competition from two very strong national rivals, plus increasing pressure from cable companies. Third, that massive debt burden we just discussed, constraining capital returns and adding financial risk, especially with potential interest rate fluctuations.
And fourth, enormous ongoing capital expenditure requirements just to maintain and upgrade its network, which depresses free cash flow after CapEx. This low valuation assigned by the market fundamentally reflects a deep skepticism about Verizon's future growth prospects. And in turn, it applies a high discount rate to its future cash flows to account for all these perceived risks. It's essentially saying, prove it to us.
So, for a company like Verizon, where growth isn't explosive, where do you find that essential margin of safety for investors? It's not a growth stock that can just grow into its valuation like a tech company might, right?
You're absolutely right. It's a different kind of investment. Unlike those hyper-growth companies where you might pay a premium today hoping for massive future earnings, a margin of safety for Verizon isn't about hoping for explosive, unforeseen growth. Instead, it's about purchasing its durable, predictable stream of cash flows at a price that provides a significant cushion against potential negative developments. This is classic value investing territory. There are a few key factors that create this margin of safety for an investment in Verizon, I think. First, there's the valuation-based margin of safety. This means purchasing the stock at a PE ratio significantly below its own long-term historical average, for instance, below 10x when its average is 11-12x. Concurrently, you'd look for a dividend yield significantly above its historical average, say above 6%. The stock's current valuation profile appears to squarely meet both of these criteria, offering a built-in cushion from its current market price. The dividend itself acts as a kind of safety net, providing a solid return even if the stock price doesn't move much. Second, there's an asset-based margin of safety. This is rooted in the immense tangible value of Verizon's physical network and its incredibly valuable portfolio of government-granted spectrum licenses. These are concrete, tangible, and intangible assets that would be nearly impossible and certainly economically irrational for a new competitor to replicate from scratch. Think of the spectrum as prime digital real estate, and the network as the physical infrastructure built on it. These provide a fundamental floor to the company's value, independent of current earnings fluctuations. And finally, there's potentially an event-driven margin of safety. An ideal entry point might arise during a period of maximum pessimism in the market. This could be a broad market-wide panic that indiscriminately sells off all equities. Or perhaps a company-specific but temporary setback, like a disappointing quarter of subscriber growth, or a minor regulatory hurdle that doesn't fundamentally impair the long-term thesis, that pushes the valuation to a cyclical low. Buying when others are fearful often provides the best margin of safety because the price already reflects extreme negativity.
Yeah, that really highlights how critical the entry price is for an investment in Verizon. It sounds like it's almost everything. Unlike other companies where maybe a high purchase price might be redeemed by explosive growth down the line, Verizon's story seems very different.
It's precisely that. For a mature, slow-growing business like Verizon, the price an investor pays is truly the ultimate determinant of their future returns. It's paramount. This is where it fundamentally differs from, say, a hyper-growth technology company, where explosive earnings growth can sometimes bail out an initially high purchase price. Verizon's returns are, by its very nature, mathematically constrained by its industry structure and growth profile. Consider a simple case study. Imagine an investor who buys Verizon at a PE of 15x, perhaps during a period of irrational market optimism or some fear of missing out moment. If the business performs adequately, but market sentiment eventually reverts to its mean, causing the PE multiple to compress back to its historical average of, say, 11x, that investor could experience mediocre or even negative capital returns over a 5-year period. In that scenario, the consistent dividend yield would likely be the only source of positive return, and it might not even be enough to offset the capital depreciation from the multiple compression. They'd basically be experiencing dead money. Conversely, an investor who buys at a more conservative PE of 9x has multiple paths to a successful outcome. They can win simply by collecting the high and secure dividend yield, which already provides a substantial return on its own. They could also benefit from modest, low single-digit earnings growth over time as the company potentially expands its FWA and enterprise segments. And crucially, they could enjoy significant capital appreciation if management successfully executes its strategy and the market's sentiment improves, causing that PE multiple to re-rate upward toward its historical average. For an investment in Verizon, the entry price isn't just important, it provides the vast majority of the margin of safety. It's truly the final hurdle that determines whether this is a long-term winner or disappointing value trap. Pay too much, and it's hard to win. #tag growth and permanent risks.
Okay, so given this mature market and the importance of price, what's the single most important growth engine for Verizon going forward? And now that the core mobile market is pretty much saturated, what's the silver bullet, if there is one, that they're really banking on?
Yeah, there isn't really a silver bullet. But the primary engine for Verizon's future earnings growth, beyond just maintaining the core, is really the successful scaling of its fixed wireless access, FWA, and enterprise businesses. With the core U.S. mobile market being largely saturated, FWA allows Verizon to truly leverage its existing 5G wireless network to directly compete with traditional cable and fiber companies for home and business broadband customers. This is a massive addressable market, where Verizon previously had a limited footprint outside of its Fios fiber optic territories, which are geographically quite limited. FWA lets them go national with home internet. They have set an ambitious target, reaching 8 to 9 million FWA subscribers by 2028. That's a significant jump from nearly 4.6 million today. If successful, this represents a substantial new revenue stream. In the enterprise space, growth will come from selling those higher value solutions we discussed earlier. Things like private 5G networks, where a company builds its own dedicated 5G network on its campus for specific, high-security, low-latency applications.
And mobile edge computing services, which bring cloud computing closer to the data source, essential for IoT and AI applications. These are the clearest, most direct paths to unlocking new incremental revenue streams from the enormous network investments they've already made, essentially finding new ways to monetize their digital toll road.
That sounds promising, absolutely. But every investment carries risk. What about the genuine long-term risks that could permanently impair the value of the business? The kind of risks that could push it squarely into value trap territory for good.
You're right, we have to look at the downside. There are 3 significant genuine risks that could permanently impair the value of Verizon's business. It's crucial for any long-term investor to understand these, as they speak directly to the durability of that wonderful company thesis. First, and arguably the most existential, is accelerated moat erosion. This is a big one. This is the possibility that a combination of rapid technological change, maybe new spectrum becomes available much cheaper, or widespread adoption of software-defined networking significantly lowers operational costs for competitors, coupled with unrelenting, effective competition from T-Mobile, AT&T, and, increasingly, those cable companies offering aggressive wireless bundles. That this combination could permanently commoditize connectivity, turn it into a race to the bottom. If Verizon's network advantage, its historical leadership, were to truly disappear, its pricing power would evaporate. Poof. This would exert severe pressure on margins and cash flows, potentially making its substantial debt burden unsustainable. And that could lead to a permanent impairment of shareholder value. It would turn a premium service into a low-margin utility.
Second, there's the risk of debt-fueled capital misallocation. This ties back directly to their capital allocation track record and that big debt load. The risk is that management, maybe feeling constrained by its already high debt load, might make another large value-destructive acquisition like the AO Yahoo debacles, desperately trying to find growth outside its core. Or perhaps just overpaying for an asset. Alternatively, they could simply fail to generate adequate returns on their massive C-band investment, effectively turning that $60 billion into a white elephant rather than a growth engine. Just a huge cost sink. Furthermore, a significant and sustained rise in interest rates could dramatically increase the cost of refinancing their enormous debt pile, permanently siphoning cash flow away from equity holders and toward debt service, leaving less for capex, dividends, or potential buybacks. And third, we must always consider adverse regulatory intervention. The telecom industry is inherently heavily regulated, always has been, always will be. The government exerts immense control over spectrum, which is the absolute lifeblood of the industry. Can't operate without it. A policy decision, for example, to flood the market with new, cheap spectrum could significantly lower barriers to entry and intensify competition in a way that truly hurts incumbents like Verizon. Moreover, as high-speed connectivity is increasingly viewed as an essential public service, like water or electricity, there's a persistent risk of political pressure on pricing. This could lead to regulations that cap Verizon's profitability
regardless of its underlying costs or competitive advantages. Such interventions could fundamentally alter the economic structure of the industry. These are not minor risks. They are fundamental threats to the business model and the wonderful company thesis. Hashtag potential catalysts.
Okay, so those are the risks, and they're significant. But what about the upside? What are some identifiable catalysts that could unlock or accelerate value creation for Verizon in the next, say, 1 to 5 years? Things that could potentially prove the wonderful company argument correct.
Yeah. Despite the risks, there are definitely a couple of key catalysts that could significantly impact Verizon's trajectory in the near to medium term. Things that could move it away from that value trap perception. First, there's the Frontier acquisition integration. We could see this playing out over the next year or two. The pending acquisition of Frontier Communications wireline assets in key states like California, Texas, and Florida, that's a significant strategic move. It's not small. This deal will dramatically expand Verizon's fiber footprint beyond its traditional Northeast territory, and fiber is crucial for high-speed internet, the best kind. Successful integration of these assets will enable Verizon to more effectively bundle its mobile services with high-speed home internet to millions of new households. This has the potential to accelerate subscriber growth, lower customer churn by creating that stickier bundle, and provide a potent competitive response to the bundling strategies already being employed heavily by AT&T and the cable companies like Comcast's Xfinity Mobile. It's about filling a significant gap in their service, offering in critical markets, and leveraging their existing network for new revenue. Second, and looking maybe a bit further out over the next 2 to 5 years, is the potential for AI-driven efficiency and accelerated deleveraging. This is interesting. Verizon is actively deploying artificial intelligence, both in its customer service operations, which we know has been a pain point based on our earlier discussion, and for network optimization, using AI to run things better. If these AI initiatives translate into significant and sustained improvements in operating margins by reducing costs, the incremental cash flow generated could be directly used to accelerate debt reduction, pay down that big pile faster. Reaching a lower leverage target, for instance, getting that net debt ratio below 2.0x would be a powerful catalyst, I think. It would de-risk the balance sheet significantly, likely lead to credit rating upgrades from the agencies, which lowers future borrowing costs. And crucially, it would provide the financial flexibility for management to potentially resume a meaningful share repurchase program. And at current valuation levels, share repurchases would be highly accretive, meaning they would significantly boost earnings per share and could unlock considerable value for shareholders just by reducing the share count. This is a clear path to value creation beyond just waiting for the dividend check. Hashtag second level thinking inquiry.
Right. So if we connect all this to the bigger picture, what's the prevailing market consensus on Verizon right now? And what's the contrarian view that this deep dive maybe suggests? Where does the market seem to be getting it wrong, if at all?
The market consensus for Verizon is pretty clear and, frankly, quite unenthusiastic. It's not a love stock right now. The prevailing narrative is that of a low-growth, debt-laden utility operating in a hyper-competitive industry. That's the story. It's often dismissed as what some people call a rumor stock, essentially a bond proxy, whose main appeal is its high dividend yield, but offering very little prospect for capital appreciation. The market sees significant risk from its massive debt load and fierce competition, believing these factors severely limit its upside potential. The general sentiment is that the market is pricing in a future of slow, steady erosion of Verizon's competitive position, with little hope of a return to robust growth. Wall Street analysts. They generally offer a lukewarm moderate buy with a significant number of hold ratings reflecting this rather unenthusiastic view. There's just not a lot of excitement or perceived alpha expected here. However, this deep dive suggests that the market may be underestimating the durability of Verizon's economic moat and perhaps overestimating the long-term risk to its dividend and cash flows. This is where the contrarian view emerges, challenging that prevailing narrative. The market appears to be overly focused, perhaps, on the negative consumer-customer feedback we discussed and the headline news of T-Mobile's 5G speed leadership in certain urban areas. Important factors, yes, but maybe not the whole story. In doing so, it may be ignoring the immense stickiness and profitability of Verizon's high-value enterprise, government, and multi-line family plan customers. These are critical. These core customers are far less likely to churn over minor price differences or even a frustrating call center experience because for them, network reliability and uptime are paramount. Their businesses depend on it, families rely on it. The cash flows generated from this core high-value customer base are likely far more resilient and predictable than the general headline noise suggests. Furthermore, the fixed wireless access, FWA opportunity, seems to be priced as a marginal contributor at best by the market, almost an afterthought. Yet our analysis suggests it's a real and substantial growth driver. If Verizon successfully achieves its target of 8 to 9 million subscribers, it will represent a significant new, high-margin revenue stream built almost entirely on existing network assets. That's real growth. This contrarian view holds that the dividend is not a return of capital from a melting ice cube designed to mask underlying weakness, but rather a well-covered return on a durable, cash-gushing, albeit slow-growing, asset. The current low valuation offers a compelling and secure yield, yes, but also significant upside potential for multiple re-rating if and when management successfully executes on its FWA growth and debt reduction plans. It's really a bet on resilience and quiet execution, not explosive growth or groundbreaking innovation. And maybe the market is missing that resilience.
So to bring it all together after that deep dive, what's the concise bull case, the core reason someone might consider owning Verizon today?
Okay, the bull case, bull down. It highlights 4 key points. First, durable toll bridge. Verizon owns an essential, nearly impossible to replicate national network in what is essentially a rational oligopoly. This core asset generates predictable, recurring cash flows from a massive and sticky customer base, particularly in those high-value enterprise and family segments. Second, attractive and secure shareholder yield. The stock offers a high dividend yield, currently over 6%. It's well covered by free cash flow and backed by that 18-year history of consecutive annual increases. This provides a substantial and reliable component of the total expected return. Third, underappreciated growth catalyst. The fixed wireless access, FWA business, represents a significant, potentially high-margin growth engine. It allows Verizon to leverage its existing 5G network to penetrate the massive U.S. home and business broadband market, providing a clear path to future earnings growth beyond the saturated mobile market. The market might be missing this. And fourth, compelling valuation and margin of safety. The stock trades at a significant discount to its own historical valuation, its peers, and the broader market. This low entry price provides a substantial margin of safety and offers the potential for significant capital appreciation from multiple re-rating if the company executes on FWA growth and successfully delevers its balance sheet.
Okay, that's the bull case. And what about the bear case? What's the counter thesis, the key reasons to be cautious or maybe even avoid the stock altogether?
Right, the bear case. Equally important to consider. It also rests on 4 critical points, I'd say. First, massive debt burden. The balance sheet is heavily leveraged following those major spectrum acquisitions. This high debt level constrains financial flexibility, prevents shareholder-friendly buybacks, and poses a significant risk in a rising interest rate environment or an economic downturn. It's a big anchor. Second, intensifying competition and moat erosion. Aggressive and effective competition, particularly from T-Mobile on 5G and from cable companies with their own wireless bundles, has definitely closed the network quality gap. This threatens to commoditize the service, eroding Verizon's historical pricing power and potentially market share. The moat isn't impenetrable. Third, questionable capital allocation record. Management has that history of value-destructive M&A in the media space, yahoos, and the decision to prioritize massive, debt-fueled network spending over potentially other uses of capital, like buybacks, has resulted in mediocre returns on invested capital for the business. Is management making the best choices? And fourth, systematic brand damage. Years of, let's face it, poor consumer-facing customer service have tarnished the brand's reputation among individuals. This has eroded brand equity, risking the transformation of Verizon from a premium service provider into just a tolerated utility, making it more vulnerable to competitors over the long term. Hashtag Red Team Challenge, inverting the bull case.
This raises a really important question. Let's invert the bull case. What's the most compelling argument for why an investment in Verizon today could turn into a major long-term mistake? Really stress test the thesis.
Okay, the strongest counter-argument, the real bear thesis, goes something like this. An investment in Verizon today is essentially a bet on a technologically lagging incumbent in a capital-intensive, low-growth industry, whose balance sheet is simply too weak to allow it to compete effectively or reward shareholders properly. The durable moat is an illusion. It's a legacy reputation that is actively crumbling as T-Mobile out-innovates on 5G technology and agile cable companies attack the home broadband market with their own aggressive wireless bundles. The fixed wireless access growth story. It's a red herring. It is arguably a technologically inferior lower-margin service competing against superior fiber optic offerings. Its growth will never be substantial enough to offset the slow, inexorable bleed in the company's high-margin core wireless business. That high dividend. It's not a sign of strength, but a siren song. a classic return of capital from a melting ice cube designed to lure unsuspecting income investors into a quintessential value trap. We would be paying for the company's past glory, not its future prospects. And the immense debt load acts as an anchor, ensuring that even if things go moderately well, the equity holders will be the last to benefit after the debt holders, bondholders, and the government via spectrum auctions have all been paid. An investment today risks buying the next AT&T of the 2010s, a decade of dead money, dividend anxiety, and immense opportunity costs compared to other investments. That's the nightmare scenario. Hashtag tag outro.
Wow, what a deep dive. We've certainly unpacked Verizon from its core business model and competitive fortress to its management's decisions, financial strength, and that complex valuation landscape. We've explored both the bull and bear cases pretty thoroughly. It's definitely a company of stark contrasts, isn't it?
Absolutely. It really is. Understanding Verizon isn't about finding simple answers, is it? It's about appreciating the nuanced interplay between its powerful core assets, its strategic choices, both good and bad, and the incredibly dynamic market it operates within. Every angle offers a crucial piece of the puzzle.
And that's exactly what this deep dive is all about. Trying to give you a shortcut to being truly well-informed, helping you connect the dots and develop your own insightful perspectives on complex companies like this. So, here's maybe a final thought for you to mull over. If Verizon's dividend truly serves as that siren song for income investors, as the bear case suggests, does its continued unwavering commitment to that payout actually prevent management from making the more aggressive, perhaps transformative moves? Things like substantial share buybacks at these currently depressed valuations, moves that could truly change the market's long-term perception of the company, moving it beyond just a tolerated utility. Something to think about. Thank you for joining us on this deep dive. Until next time, keep learning and stay curious.